Recently, gold prices have hit new highs again. I'm sure many of you are asking, can gold keep rising? Is it still a good time to buy? Should I continue to include gold in my portfolio? These questions all point to one core issue. What is the true value logic of gold? In this video, I'll help you sort out the core logic behind gold's price. By the end, you'll not only understand gold's unique role in investing more clearly, but also grasp its essence as a tool for asset allocation. So make sure you watch until the end. I believe you'll gain a whole new perspective on gold. Let's start with the nature of gold. Gold is a typical, non-yielding asset. What does that mean? It means it doesn't generate cash flow. Unlike stocks, gold doesn't pay dividends, and unlike bonds, it doesn't provide interest. In other words, holding gold won't bring you continuous cash returns. Precisely because of this, in theory, gold's price mainly depends on supply and demand. So let's first look at the supply side. This chart shows global gold supply, which mainly comes from mining and recycled gold. Over the past decade, supply has remained relatively stable, staying between 4,000 and 5,000 tons. In contrast, the real swings come from the demand side. Gold demand has several components: jewelry, technology use, central bank purchases, and investment demand. From the chart, we can see that the biggest volatility usually comes from investment demand, which fluctuates significantly from year to year. It is this sharp change in investment demand that often drives large short-term price swings. And behind investment demand, there are really two core drivers. First, the cost of holding gold, and second, its value as a safe haven. Once you understand these two, you understand the true logic of gold prices. Let's start with the cost of holding gold. As mentioned earlier, gold is an asset with no cash flow. The real cost of holding it is the opportunity cost of not investing in other assets. The most direct measure of opportunity cost is the yield on U.S. Treasuries. When Treasury yields rise, bonds become more attractive because they pay interest, while gold generates nothing, so gold often comes under pressure. Treasury yields are closely tied to monetary policy, which links gold prices directly to monetary policy and the strength of the dollar. When the Fed tightens policy, interest rates tend to rise, Treasury yields rise, and the opportunity cost of holding gold increases, making gold less attractive. As a result, gold prices usually drop. On the flip side, when the Fed eases policy, interest rates and the dollar fall, and gold prices go up. For example, between 2013 and 2015, the Fed announced it would gradually exit quantitative easing and began signaling rate hikes. During that time, the dollar index strengthened significantly, while gold prices fell from about $1,800 per ounce to around $1,050. This is a textbook example of how monetary policy, interest rates, the dollar, and gold interact. However, this pattern doesn't always hold. In 2024, even though Treasury yields were rising and the dollar was strong at times, gold still hit record highs. This brings us to the second driver of investment demand, its safe haven value. Gold has long been considered one of the most important safe haven assets in financial markets. Looking at correlation data, gold's correlation with other major asset classes like stocks and bonds is very low. This means that when other assets fall, gold often diversifies risk. So whenever there are concerns about economic recession, financial crisis risks, or geopolitical tensions, investors tend to move money into gold. Interestingly, even before a crisis happens, as long as there's fear in the market, gold demand can spike. In other words, gold prices reflect not only real risks, but also people's psychological reactions to uncertainty. When we combine these two drivers, you can see that gold's price is essentially determined by the balance between its safe haven value and its holding cost. In other words, it's about weighing the sense of security from holding gold against the opportunity cost of holding it. Normally, if the holding cost of gold is high, like when Treasury yields rise, gold looks less attractive and prices usually fall. But this is not always the case. If at the same time, safe haven demand surges, for example due to geopolitical conflict or worries about fiat currency credibility, gold's safe haven value can jump. As long as this jump outweighs the rise in holding cost, gold prices can still go up. Take the Russia-Ukraine conflict as an example. Even though U.S. interest rates were still high at the time, making gold expensive to hold, safe haven demand exploded. Central banks and investors bought heavily, pushing gold from about $2,000 per ounce to above $2,400. This shows that gold's pricing logic is not just about supply and demand curves, but about whether safe haven value or holding cost dominates. When safe haven value far exceeds holding cost, gold becomes the market's safe harbor. If we apply this logic to today's environment, we see that gold's safe haven value remains elevated. Geopolitical risks and fiscal deficits around the world haven't eased, and concerns about fiat currency credibility remain, all of which keep boosting gold's safe haven role. At the same time, central banks, especially in emerging markets, are still increasing their gold reserves, reinforcing its role as a safe haven. Now let's look at holding cost. On Wednesday, the Fed announced a 25 basis point rate cut, the first since December 2024. This sends a signal that Treasury yields may continue trending downward. If yields fall, the dollar is likely to weaken, which lowers the opportunity cost of holding gold. In other words, the two forces supporting gold, high safe haven demand and falling holding costs, could show up at the same time in the near future. So even though gold prices are already high, there's still room for them to rise. In the short run, there may be volatility, but in the medium to long run, gold remains an asset worth holding. But here's something to keep in mind. Many people treat gold as an absolutely safe asset, but that's not true. Gold's annualized volatility is around 20%. This means that in some years, it might rise 20%, but in others, it could fall 20%. Such volatility can significantly affect your overall portfolio risk. In other words, while gold can hedge and diversify in the long term, in the short term it can also bring substantial losses. If you chase gold at the top and the market pulls back, you could get stuck. Personally, I treat gold as a supplementary allocation, not a core holding. I usually prefer to buy gradually when prices pull back or when fear in the market isn't too high, rather than chasing highs. This way, you still get the benefits of hedging and diversification while keeping volatility under control. All right, that's it for today's video. If you found this content helpful, make sure to give it a thumbs up and subscribe so you don't miss future updates. Feel free to share this video with anyone interested in gold investing. And if you have thoughts on gold as an investment, leave a comment below so we can discuss together. Your support is my biggest motivation to keep going.